Hey everyone! Have you ever wondered how some traders seem to make money no matter what the market is doing? Whether a stock is soaring or, well, even when it's crashing? That's the power of options trading. So, over the next few minutes, we're going to break down the two absolute core concepts, calls and puts. By the end, you'll have the fundamental knowledge to understand this incredible financial tool.
Yeah, that's the big question, right? Making money when a stock is climbing? That seems pretty straightforward. But what about when it's falling? How do you actually turn a downturn into a real opportunity? Well, that's exactly where options come into play. And by the end of this, you'll see exactly how both of those scenarios work.
Okay, so first things first. Before we get into any cool strategies or anything like that, we have to lay the groundwork. We need to establish what an option contract actually is. And that phrase right there, the right but not the obligation, that is everything when it comes to options. You have to get this part. Think of it like you're buying choice. You're paying a small fee to secure the right to buy or sell a stock at a price you agree on today, but, and this is key, you're never forced to do it if the trade doesn't look like a winner.
So it really just boils down to two simple directions. If you're bullish, like a bull with its horns charging up, you think a stock's price is headed higher. That's when you'd use a call option. But if you're bearish, like a bear swiping its claws down, and you think the stock is about to drop, that's where put options come in. Up or down. Simple as that.
All right, let's start with the fun stuff. Betting on the upside with call options. This is your go-to move when you've done the research and you believe a stock is really primed for a climb.
And yeah, that's the million-dollar question, isn't it? Just having a gut feeling? That's not a strategy. The pros, they have a checklist. They are looking for very specific signals before they put any money on the line. So what's on that list?
Okay, so here's what a typical checklist looks like. You want a stock that's already trending up, right? Maybe there's some good news or a big earnings report coming. Buying near a support level, that's a price where the stock historically stops falling and bounces back, that can help minimize your risk. You also want to see high trading volume, because that confirms lots of people are interested. And finally, you look for low implied volatility, or IV. Just think of IV as how much chaos the market expects. When it's low, options are cheaper.
So here's how to think about it in practice. You're basically paying a small fee today, that's called the premium, to lock in today's purchase price for the future. You get the right to buy 100 shares at that locked-in price. So if the stock absolutely takes off and goes to the moon, your price is still locked in way down here. That gap, that's your profit.
Okay, now let's flip the script. What if your research is telling you a stock is way overvalued, or maybe it's heading for some serious trouble? Welcome to the world of put options, which are literally designed to profit from a stock going down.
The logic here is exactly the same as with calls. It's just in reverse. You're not just throwing a dart at a board. You are looking for specific, evidence-based signals that a stock's price is about to take a hit. And here's that checklist for puts. You're looking for a stock that's already in a downtrend, maybe there's some bad news or a weak earnings report out. If the stock breaks below one of those key support levels we talked about, that's a huge red flag, and high selling volume confirms that, yeah, sellers are definitely in control here.
And here's a really cool thing about puts. They aren't just for betting against a stock. They can also be a powerful form of insurance. So if you own a bunch of stocks and you're getting nervous about a big market drop, buying puts can act like an insurance policy that could help offset some of your losses if things go south.
All right, we've got the what down. Calls for up, puts for down. Got it? Now it's time to learn how to speak the language. Because to trade options well, you have to understand the key metrics that actually control their price and their value. Let's quickly run through these. Delta tells you how much your options price will move for every $1 move in the stock. Super important. Then you've got theta, and this one's a killer. It's often just called time decay. It's the little bit of value your option loses every single day. Time is literally money with options. We mentioned implied volatility, or IV, before. That's the market's guess on how wild the stock's ride will be. High IV means options are more expensive. And finally, the strike price and the expiration date, those are the heart of your contract. That's the price you can buy or sell at, and the day that right vanishes forever. You have to remember, every option you buy is a race against the clock. That theta decay we just talked about, it gets faster and faster as you get closer to the expiration date. It's like a melting ice cube. This means you don't just have to be right about the direction of the stock, you have to be right about the timing. So, you see how this all starts to come together? Understanding the mechanics? That's step one. But the real difference between a successful options trader and someone who just gambles their money away It almost always comes down to mindset and having a solid set of principles. These 4 rules right here are timeless. Seriously. First, options are risky, so you should never, ever risk more than you're willing to lose. Period. Second, do your homework. Look at the charts and the health of the company. And please, before you use real money, practice with a fake account first. Most importantly, you have to learn to control fear and greed. They will wreck your account.
And that quote right there, that really says it all. A plan means you know your entry point, you know your exit point for a profit, and you know exactly where you'll cut your losses before you even click the buy button. Anything less than that isn't trading, it's just gambling.
Because ultimately, it all comes down to this. Options can give you incredible leverage and amazing potential, but they absolutely demand respect, knowledge, and a ton of discipline. So as you think about all this, you have to ask yourself, which one are you going to be?